Hello, today is Tuesday, February 22nd, and we wanted to take a moment here to talk about regimes. This is a market that is dominated by put positions, the hedging flow around those put positions. That is what invokes this idea of negative gamma. That is what invokes the high volatility and a lot of the movement that we are seeing in markets today. Now, today's session was typical of what we've seen over the last several days. You'll note that off of the open, we saw a very big rally. It was around a 40-point rally off of the open. That rally fades, leads all the way down to 42.70. Biden makes a few comments, which leads to a 60-point rally, and then once again, that move fades. So these large intraday swings are taking place in the context of a market that, over the slightly longer term, is putting in lower lows. You can see here we are now sitting right at the January lows, or just off of those January lows. And there's not much clarity on when this put heavy regime will end. So why do we call it a put heavy regime? Well, for that, let's flip over to this chart. And on this chart, we characterize call positions at the top. They are labeled with a positive gamma figure. So this bar measures how large call gamma is. And then on the bottom, we measure put gamma, which is characterized by the negative bars on this chart. So you can see that here for the SPX, there are much larger negative put gamma bars on this chart than the positive call gamma bars that you are seeing. So in this context, this is what drives us to make the comment that this is a market controlled by put options. If we flip over to the spider position, it's even more obvious. You can see these are very, very large put positions, and these are matched up against relatively small call positions. So the S&P trading right in and around here, you can see that it's put gamma, that is negative gamma, that is dominating the market flow. And as new puts come into the market, dealers must short additional shares of stock. As those puts are closed, dealers can buy back. And that is what is leading to the volatility. If you look at our note from this morning, and if you're interested in trying out our service, you can go to subscribe now and get a free 7-day trial. But we send these notes out every morning. And what you can see on here is for today, we noted two key levels. That was 4,300 and 4,370 as support. And the other thing we mentioned was that any rally should be characterized as a short cover rally. And that is because when puts are closed or implied volatility comes down, dealers can buy back short hedges. And for those of you who are familiar with the idea of a short cover rally, once the shorts are done covering, there's no more buying that's really there to take place, right? That buying happens in a vacuum. When it's done, there's no more support. And so any rally can quickly mean revert. And so when you consider puts being closed or implied volatility coming down, dealers can buy back shorts. Well, once that flow is done, there's nothing really to support the market again as the market starts to drive lower. And so this idea of short cover rallies, they can be violent, but they can fade very quickly, is something that we've been harping on for several days. And again, if you flip back to today's market, you can see that we had very large support at 42.70, but we had very large intraday swings, again, in the context of the market making lower lows. Now, what is it going to take for the market to clear out these put positions and possibly set up for a big rally? Well, many of you know that we've seen important market lows in the past marked by options expirations. Most importantly, we'd flag March 16th, 2020 and December 17th of 2018 as two key dates. Those are quarterly options expirations. And as you could see, the market was very weak into those expirations. Those expirations happen and they clear out put positions. So these hedging flows around big put positions are gone simply because of the fact that those puts are expired. That can lead, we believe, to deltas being bought back by dealers, which can invoke strong rallies. There was also another rally in and around January 18th with a very large expiration, which we chronicled at length on our site, SpotGamma.com. And so with that, while we don't cover macro flows, we would just say that we think that the major driver of uncertainty and therefore demand for downside protection in this market is around monetary policy. And until that is cleared up, until the market has a better understanding of the path going forward, they're likely to want to continue to own put protection. Now, we wanted to bring down the calendar because we want to show two interesting dates. So on March 16th, we have the FOMC, which is really the first place where the market could get some concrete policy expectations. And that is followed 2 days later by a very large quarterly options expiration. So we are highlighting the 17th and 18th as a time from an options positioning standpoint to look for the prospect of a fairly sharp rally in markets off of the back of the fact that we think that there will be some clarity or understanding for the markets going forward, and that may lead to a reduction in put demand, which can help drive a rally. Now, before we go, we wanted to show one other piece of information, and this is just basic open interest as of Friday for the S&P 500. Now, at the time we made this chart, the S&P was trading right around 43.50, so we closed just under that. But what we wanted to highlight was this very large open interest position at the 4,000 strike. And we think that if the market does happen to slip that low, that this would be strong interim support based on the hedging flows that this could invoke. Now, if we flip back to our daily note, we also highlighted this from a gamma perspective and not an open interest perspective. But what you can see here is, in the same way that we saw 42.70 as support for today, we see there is very large open interest at 4,000. And that signals that there is a large change in the gamma position of the S&P 500 as we pull into that 4,000 strike. And for that reason, we would look for this to be an interim low over the next several weeks. So based on this data and information, we think that this high volatility regime will persist in through mid-March. And if we do visit the 4,000 area to the downside, we would look for that as material support. If you have any questions, please leave them in the comments section below or send us an email at info@spotgamma.com.